Welcome to another monthly Big Picture episode of the Michael Yardney podcast. Each month I get together with leading financial commentator Pete Wargent, who brings decades of perspective to his views. And today, once again, we're going to discuss the clues in the news as to what's ahead for our economy and our property markets. We're going to talk about inflation and interest rates and what this means for our property markets. We'll give you an update on what APRA had to say about when they plan to loosen their lending buffers. We'll share the latest home loan approval figures, which give us a bit of an indication of what's ahead because people get their home loans, their mortgage approvals, usually in advance of going out into the market. We'll discuss what the plan to reduce international students to Australia could mean to our housing markets and the economy, and then we'll talk about what's really happening in the Melbourne property market. Boy, lots to discuss, but I hope at the end of today's show you'll have a bit more clarity considering all the mixed messages in the media. So let's get on with my chat with Pete.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Pete, I always enjoy our Big Picture podcast, and since we last spoke, you've been travelling around Europe. Where are you now?
I'm in England, actually.
Back there.
Yeah, dodging in and out of the protests this week. Has had a change of government over in United Kingdom, and there's been a lot of tension for various reasons. But yeah, I've also been in Greece over the past couple of weeks and just enjoying a bit of travel and European summer. It's all good.
Fantastic. Now, I know your latest book has just been released, and I want to have a bit of a chat about that in a moment. But maybe let's start with some old news, yet it's still worthwhile talking about because it will be relevant for anyone who's interested in property. The June quarter inflation figures were maybe not exactly what the Reserve Bank had been hoping for, and yet they kept interest rates on hold at their recent meeting at the beginning of August.
Yeah, it was pretty interesting, actually, because I was in Greece on the day the inflation figures were released, and I can't remember an economic release that was as keenly anticipated as this one. There was quite a few, nervous traders watching that, and I guess people with mortgages were quite keen to see what would happen with inflation. And market forecasts were for inflation of around 0.9% for the core inflation figure, and it came in at 0.8. And it's funny how these real fine margins can make a difference, because I think if you looked at it to two decimal places, it was 0.84. But, people were so worried about an overshoot of inflation. And when I logged on in the morning, I looked at the 3-year bond yield and it absolutely plunged about 20 basis points. The Aussie dollar responded, and the market pricing for interest rates just evaporated. So even before I'd looked at the inflation figures, I could see what had happened. It was like a collective sigh of relief. So I think if you look at the September quarter, which we're now living through, inflation could be flat, I guess, with government subsidies for energy bills and things like that. I think the core inflation figure will be, or what the Reserve Bank watches, what they call the trimmed mean inflation. So yes, you mentioned the RBA decision, and obviously there was no dovish tilt or anything.
Well, actually, the Governor, Michelle Bullock, actually made it clear that at the moment, interest rates are going to remain where they are and don't even expect any rate reductions before the end of the year. She said something along the lines of, I think the board's feeling is that in the near term, at least for the next 6 months, interest rates aren't going to change.
There was no dovish tilt, was there? I think, though,
No.
If you think about it, it makes sense. The last thing the Reserve Bank wants is for inflation to get back down towards target and then to see sentiment kicking back up and inflation taking off again. So definitely talking tough, but actually, if you follow market pricing, quite a big shift over the past week or week and a half. So obviously, that's the communication from the Reserve Bank. But don't forget, what the Reserve Bank says and what it ends up doing doesn't always align. If you remember, it's not so long ago, the Reserve Bank said there would be no increases in interest rates for a couple of years, and then markets changed and things took off. So, yeah, but talking tough, jawboning in the economic
Well, yes,
parlance.
that's part of the way they control how we spend and what we think. Having said that, the market believes interest rates are going to fall. I know that the big four banks have changed their forecasts. CBA and Westpac believe the first interest rate fall is going to happen in November this year. ANZ think in February. National Australia Bank's a little bit more pessimistic and don't think rates are going to start falling until May next year. But the money market has changed. And of course, a short while ago, there was that ruckus in the share market where suddenly there was talk about recession. And then all of a sudden interest rates and the money market dropped again, Pete.
It's been a bit of a volatile week or two. I think, yes, some talk about recession fears in the US. I mean, realistically, interest rates in the US are going to start coming down very sharply beginning next month in September, probably with 50 basis points. And there'll be a lot more to come over the next 18 months. So I think the Federal Reserve's got a lot of firepower up its sleeve to avoid a significant recession. But yeah, some jitters in stock markets and financial markets. I think if you look at what's coming for Australia. So we've got monthly inflation figures these days, and the RBA governor said they probably place a bit less emphasis on that, but you'll see annual inflation on that gauge comes down over the next 3 or 4 months, partly due to the base effect from what happened a year earlier. The next official inflation quarterly figures will be for the period to 30 September. They'll be released towards the end of October. So I guess, yeah, from November onwards, who knows? We might be starting to talk about easing, but nothing before then.
No. Well, it always happens around Cup Day, doesn't it? One way or another, there seems to be a Melbourne Cup Day, first Tuesday of November, interest rate change in one direction
Often
or
a
another.
live decision, yeah. And if you look at, as you mentioned, money markets, well, if you look at 3-year bond yields in Australia, that's a key funding benchmark for our banks, and it's well down. So actually, you probably start to see fixed rate mortgages starting to be cut immediately. Most borrowers, of course, are taking variable rates now anyway, but it's just an indicator of what's to come, I think. And actually, market pricing, if you look out at, just opening my Bloomberg, January 2026, well, under 3.5%. So at least 3 cuts, you'd think, over the next 18 months, based on what markets are expecting.
Interesting. Well, we know the Reserve Bank's trying to quell inflation with high interest rates, and it also is hoping to lift unemployment a bit by slowing business growth, and that's going to slow wages growth. But the Reserve Bank's got a bit of a dilemma, because when you look at the way our unemployment figures, or maybe the other way around, our jobs figures are going, there's 2 tiers. The government sector's booming, Pete, at both the state and federal level, but small businesses are increasingly being squeezed out by regulations, more challenges and competition for jobs from, I guess, better paid public purse.
It's what Tarek Brooker calls the burnout economy. The Reserve Bank is really trying to slow down the economy, slow down inflation. And on the other side of the equation, the government has been pumping up public demand. And there's been a lot of jobs growth in things like the public sector, the NDIS, government hiring. We've got 14.4 million employed persons in the country, which is obviously the biggest we've ever seen. And that's up 388,000 over the year. But as you said, there's not much job creation going on in the private sector. I guess what the RBA is going to be watching, the unemployment rate in Australia was at a low in July 2022 of 3.5%. Now it's 4.1, and job ads are down, 22% from the high. So the labour force is going to cool. I think if you look at what's happening elsewhere, New Zealand's unemployment rate was up to 4.6, US rose to 4.3. I think you might read a little bit about what they call the SARM rule over the next few months, and that it's kind of it's not really a rule, I suppose, but it's an indicator of a potential recession in the US when the unemployment rate rises by 1% over the course of 12 months, and whether that's on a monthly or moving average basis. Well, yeah, if you look at Australia, we're not quite there yet, 3.5% to 4.1. So, but a few more sort of increases in the unemployment rate, and it starts to look a bit messier. So obviously the RBA is going to be watching that really closely.
Well, as a property investor, we want to be able to borrow more, refinance. And one of the things that's been restricting us is APRA, the Australian Prudential Regulation Authority, which has made the banks add 3% to interest rates. We know that servicing a loan's, I guess, almost harder than ever. It's not just the interest rates, but this serviceability buffer. And we've all been hoping APRA would slowly lower that. But recently, APRA came out and said they've got no way that they're going to loosen the screws. Not in the short term anyway, Pete.
Not yet. So APRA is part of the Council of Financial Regulators these days. And I think what's happening is until inflation is definitively beaten, there's going to be no change to the buffer. And I guess once inflation's back in the target range and there's no risk of it kicking back up again, then the lending assessment buffer will go back to normal. Realistically, it should be released. If you look at money market pricing, it's for lower interest rates over the next year and a half. So why have we got an extraordinary buffer in place?
Yes.
What it's doing, it's locking out first home buyers. It's restricting new apartment sales and therefore housing supply. And in fact, APRA's own data shows there's very little high debt to income borrowing. There's very little high LVR borrowing, and there's almost no low doc lending these days. So I don't know why the buffer's there, but I guess it's just part of that inflation targeting battle, and eventually it will get released, but maybe not till next year.
So eventually, as interest rates fall, APRA's lending restrictions are going to be loosened a little bit. The combination of that's going to mean more money in the system, more affordability, more people getting back into the market. At the moment, we know that the stock on market is very low. In fact, this morning before we hopped on to have this chat, I looked at your daily blog, which I enjoy getting, and it talked about the lower level of housing at the moment of listings. But on the other hand, home loans have been rising. It's been investors, interestingly, in the market as well, borrowing. So some people have got a better long-term view than others.
Yeah, so it looks like investment loans were up to 11 billion for the month. That's the highest in 2 years. And if you look at the recent strength, it's largely been driven by New South Wales. So investors getting a bit more confidence there.
Yeah.
I was interested to see that maybe something we'll talk about later on in the chat, but New South Wales Premier Minns demanding government workers back into the office from Monday. So maybe that pulls some demand away from the coastal lifestyle markets and back into the cities. But yeah, definitely some resi landlords getting back in, I guess, thinking about lower interest rates ahead. The average home loan for owner-occupiers hit a new record high, but I do wonder whether those averages are getting skewed because a lot of the lower income earners are locked out from buying a home, so they're being captured in the investor numbers. I suppose one other thing there, the new home loans written just seem to tick up a little bit, so maybe through the bottom for that sort of, it's been very, very soft, of course. But I did see over the past week, Mirvac released their annual report, and their pre-sales for 2024 have just collapsed. So 2025 guidance is revised down. There's no money in building apartments at the moment. So.
No, we've said that a few times, which means also that there's not going to be any way we're going to reach that target of 1.2 million new dwellings that the government's hoping for.
No, and that's the thing. I guess there will be a supply response eventually, but not with interest rates where they are. I think if interest rates fall and housing prices rise, then developers might get building. But at the moment, apartment pre-sales are weak. Housing supply is weak. Yeah, the shortage is going to get worse over the next year or two. It's something the RBA actually highlighted in their statement on monetary policy as well.
Well, just to put some context to it, over the last 12 months, the total value of new investor loans has gone up 30.2% compared to a year ago. Now, of course, the cost of a dwelling to buy as an investment has gone up as well, but proportionately, the number of dollar value of loans is even higher. On the other hand, owner-occupier loans only went up 13.2%. I guess this is also restricting how many people are in the market, but I like looking at new home loan approvals because it is a forward-looking indicator. So there are people out there. It shows there's going to remain depth in the market. And I guess it's also interesting that the negative Nellies, the property pessimists, have disappeared, not finding as many of those on the internet now as there was a couple of years ago.
There does seem to be a bit of a inevitability, just given the way everything's set up at the moment. The stars never align for property investors. It just doesn't happen that everything lines up. But at the moment, you've got high population growth, low housing supply, money markets pricing for interest rate cuts over the next 18 months and beyond. Yeah, potentially APRA easing the buffer. We've got tax cuts. Most people are in a job. Employment's still strong. So, yeah, I mean, there's always risks and you need to do your due diligence. But I guess the outlook for the next few years is pretty solid.
Now, I'll take you up on what you were saying just a moment ago about Chris Minns and the New South Wales government suggesting that it's wanting public servants to go back into the office more. In response to that, the Victorian government said, "Oh, that's okay. Come here to Victoria. We'll let you work from home." Funny about that.
It's an interesting tug of war, this one. I think when the unemployment rate was 3.5%, all of the balance of power was with workers and not employers. So people were working from home. They could pick and choose their roles and they were moving to the Gold Coast and all the rest of it. Obviously, as the unemployment rate rises back towards 5%, the balance of power shifts a bit more back in favour of the employer. But it does seem that we're ending up with a bit of a hybrid model where a lot of employers are saying, well, come into the office 3 or 4 days, maybe not 5. So it's definitely reduced the demand for office space. And in fact, that was one of the big issues in Mirvac's annual report. Office valuations have been clobbered because there's more people spending more time working from home. But yeah, gradually some of the big employers are trying to sort of guide people back to the office. So it's an ongoing issue, that one hasn't been resolved.
Now, I want to ask you a couple more property-related questions, but before we do, I know that you've written a number of books now, and we both know the amount of work that goes into it. I mean, if anyone, or lots of young people are now writing books too, How I Flicked Hamburgers 5 years ago, and now I'm flipping properties. But you and Kate Bakos, who've been in the market for a long time, are bringing a different depth to your writings. So tell us about your book. How's it going, and what made you go to the effort of writing another one?
Well, no flipping hamburgers for me, I'm afraid, as a vegetarian. But the book's the buy right approach to property investing, mastering the skills to invest wisely in property. So Kate, as you know, she's been an industry stalwart over a very long time now. Don't actually know that, over a decade in her own business and plenty of experience before
actually,
that.
Well, I think following her on Instagram, and we're friends as well, it was a 10-year anniversary for her own business, and she was in a different business before, so she's been in property a while. And I think that brings a depth of knowledge that a lot of these young people, they've done okay during booming times, but haven't gone through the ups and downs that cycles teach you.
That's right. I think some of the best parts of the book, for me anyway, where Kate brings real world experience. I think that there's a lot of theory written about economics and market cycles and stuff, but Kate's been there and done it over 20 plus years. As you mentioned, she previously worked, before working as a buyer's agent, she did mortgage broking, she's done other bits and pieces. So a lot of the sort of real world examples that she uses bring the book to life. And one of the things that really stands out is how people try and fine tune their timing into the market. But as she shows by looking at some of her real world examples, a lot of her best performing investments have been done when inflation was high, or interest rates were going up, or there was talk about a recession or the global financial crisis. But when you map it out over the long run, it's actually buying the right asset that makes the big difference, much more so than the timing, the longer you own the asset for.
Definitely. You get a free kick if you buy it cheaply or get the timing right, but that's a short-term thing. Much more valuable is the long-term outperformance. And during the booms like we experienced a couple of years ago, everything sells. During the last year or two, rents go up, skyrocketed really for almost every property. But the market's going to turn. It always does. It cycles. And it's the well-located investment grade, A-grade properties in top locations that will give you the long-term outperformance. So I'm going to leave a link in the show notes because there aren't that many bookshops around at the moment, Pete. It's a shame unless you go to the airport where I know your book's there. So I'll leave a link to Amazon where people can get it and read about the buy right way of investing in property. One of the other things that was in the news recently was about universities warning what would happen if we lost international student enrolments. We know that the government, I think in response to complaints, probably because it's an election year, said it was going to cap overseas enrolments. Now, Australia makes in a big picture, that's what this podcast is about, in the big picture view, makes its money no longer as manufacturing. And yes, we know we're a knowledge-based economy, but in general, we dig things out of the ground and sell them overseas, minerals, we grow things in the ground and sell them. But the third biggest export industry, is education. Now, not everyone sees it as an export industry, do they, Pete? But it actually does bring a lot of money from overseas. And then, of course, there's tourism. But universities have warned that the proposal to cap enrolments is going to lose jobs. Jobs will be lost. Somebody's got to pay for these universities. And at the moment, foreign investors are paying for this. It'd be a real shame to lose our position in the world as an education centre.
There's two sides to this debate, isn't there? Now, I don't have a dog in the race because I'm not in higher education, not an academic. There was a proposed report talking about the government capping university enrolments at 40% international students. Now, the government's since come back and said, well, no, that's not what we're proposing. Universities have had reports out saying if you introduce a cap, there'll be a recession. They've also said, well, look at rental vacancy rates. There's no difference made by international students because look at the suburbs around where the unis are. There's a lot of back and forth going on. I suppose, look, some people would say, well, why cap? If it's a net benefit for Australia to have students come and study, they pay quite significant fees to study in Australia, and
yes,
there's a boost to the economy that way.
And they also boost the jobs. Remember in the old days when it was difficult to find a barista or people to serve in restaurants or things like that, the students provide vibrancy to our cities. Imagine what the CBDs would be like without all those foreign students.
Well, that was certainly noticeable on the Sunshine Coast when we didn't have students around. There was nobody in the cafes and there were massive shortages. We also lost the working holiday makers. I guess, why is the government doing this? I guess part of the reason is that Labour's trying to cut net immigration because in 2023 financial year, it was over 500,000 and they want to get it back down to some kind of normal level by FY 2025. It's just over 250,000. So the cuts have got to come from somewhere, and that's part of the proposed way of going about it. Now, that in July, Labour actually doubled the non-refundable application fee for international students, and that was part of just trying to, at the margin anyway, bring the numbers down a bit. So, yeah, look, there's two sides to the argument. Obviously, it does create more rental demand in the inner cities.
But in particular suburbs, particular locations, I know in Melbourne in particular, there's quite an industry in student accommodation, and that's not going to suddenly be taken over by social housing or affordable housing. The accommodation that they've built for students isn't generally suitable for general accommodation.
No, a lot of it, and a lot of university accommodation is student specific these days. It has changed a bit since my day when we used to shack up in goodness knows what old terraces and things like that. So a lot of the quality has actually changed a lot. So yeah, that one. Look, there's a kernel of truth in both sides of the debate. We've got a large number of international student visas now. It's over 600,000. So it is a significant chunk of the economy. So we'll see how that one plays out. But I expect actually immigration will gradually meander its way back down towards more normal levels over the next year or two.
Now, just to finish off, we won't talk too much politics, but there are some interesting things happening in the United States politically. We'll see how that all plays out because Australia will have some spin-off, some side effects from that. But there's also been talk about a recession in the United States. We touched on that a little while ago when we talked about the stock market jitters a while ago. What are people worried about there?
Well, the Psalm rule is actually one of the things that triggered this whole debate because the unemployment rate, we got one bad jobs report basically, and we saw the unemployment rate rise to 4.3%. So still pretty low, but it's obviously well up from the lows. I think, though, the counter argument here, if you look at inflation expectations, if you look at what markets are expecting, back under 2% now. So there's loads of firepower that the Federal Reserve can start cutting interest rates from September. They'll probably go 50 basis points. If we look at market pricing out to the middle of 2026, down to 3%. So that's down from 5.25% to 5.5% today. So massive amount of easing of interest rates coming. So yeah, look, there's definitely risks of a technical recession and a slowdown, but there's a lot of firepower there for the Federal Reserve. And therefore, at this point, markets had a bit of a jitter. Don't forget, stock market valuations were very high. So it's not really that unusual to see a 10% pullback. But things seem to have calmed down a bit over the last day or two.
Well, each month we get together, we talk about the big picture factors that are going to affect our economy, our property markets. In general, we seem to keep falling back to interest rates and the CPI, but there are other factors. When you put them all together, the future looks pretty good. Our economy is doing a bit better in general than the Reserve Bank would like. Interest rates have peaked and, well, almost certainly, I'm pretty sure they have peaked and they're going to fall. Inflation is coming under control, and the Reserve Bank believes it's going to fall within its target band by the end of next year, 2025. We've got a growing population and a huge shortage of accommodation. No way we're going to fix that. So the long-term fundamentals for property look pretty good, Pete.
Pretty strong, I think. Interesting travelling around. You do get a different perspective on the world, and so many countries now are struggling with low fertility rates, but Australia has really been on the front foot there with running a strong immigration program really for 20 years since the start of the resources boom or thereabouts. So, it's not really such a big issue for Australia. The population forecasts are all just up and up, essentially. As you mentioned, there's just so many things, so many tailwinds for Australia, resources, wealth. You mentioned international education and students and tourism and construction. So, there's a lot of tailwinds behind Australia, and obviously there's low government debt as well. So a lot of the issues that are plaguing countries in Europe and some parts of Asia, Australia's well positioned, and it's reflected in very high household wealth these days.
Definitely. Having said that, we've got very fragmented markets, and that's the way it always works. Other than that once-in-a-generation boom we had a couple of years ago when every property went up, secondary properties, main road properties. So there's no doubt that the Perth, the Brisbane, and to a degree the Adelaide market are the star performers. Then Melbourne and Canberra have, I guess, Sydney's done well too, not as well. Melbourne and Canberra have underperformed. I think Melbourne's underperformance in many ways, though, is due to Melbourne's economy. Sure, there's the ongoing impact of the debts that the local government's taken on, and in some ways the impact of the lockdowns that happened so long ago, but small businesses just didn't survive that. And there's also the extra tax burden. So while you said a moment ago, generally low government debt, maybe that's not really true for the Victorian government.
At the state level, yes. I think that will be resolved one way or another. I'm not really much of a religious person, but I think it was in the Bible where it said the last may be first and the first may be last. And that's the thing. Melbourne has actually been one of the weakest performing markets since the onset of the pandemic. Prices down a bit over the past quarter, but if you look over the past decade, it's often been the worst performing capital cities that go on over the following decade to be the best. So if you're a counter-cyclical investor and you've got a budget that doesn't quite stretch to Sydney, well, Melbourne's probably looking like prime position at the moment.
Well, that's an interesting point, because the differential between Melbourne and Sydney median house prices is the biggest it's been in a long time. So I actually think, despite all those struggles, there is a significant opportunity in the Melbourne market. Property prices are really quite considerably below replacement cost. And if you've got a long-term perspective, it is a unique buying opportunity. I know some people are suggesting it's actually similar to where Brisbane and Perth were 3 years ago. Back then, those cities are experiencing the end of their period of underperformance. And those who bought at that time, boy, they've done very well, haven't they?
Oh, yeah. And even for units in Melbourne, if you look at a lot of units in really good areas are now literally are below replacement cost. So, and I can say this as an independent person because I'm Queensland based. Most of the property I own is in Sydney and Brisbane. So it's not really self-interest talking. I'm just looking at the cycle. If you look at Adelaide's median dwelling value, it's the same as Melbourne. It's probably going to overtake Melbourne in the next month. And look, that's a compositional thing because there's more units in Melbourne, but it does sort of speak to Melbourne being towards the bottom of the cycle, and it's got the biggest population growth and the biggest population growth projection. So if the banks were lending a bit more money, I'd probably buy in Melbourne myself.
Well, somebody that you quote often, and I quote in our blogs and Property Update, AMP Chief Economist Shane Oliver suggested that Melbourne's lengthy period of underperformance has primed the city for robust growth. He said it may take several rate cuts to fire up the Melbourne housing prices, but when it occurs, it should come back with greater strength than we've likely to see in Brisbane and Adelaide and quite possibly Perth, depending upon what happens with commodity prices. So he's suggesting anyone who buys in Melbourne at the moment will get a bit of a free kick and then it'll revert to the mean. We'll just have to see when that happens. I think in the meantime, though, the Victorian government's going to really have to find an alternative source to address its debt problems, Pete. At the moment, it's imposing burdens on not just property investors, but also on businesses. Don't want to get too political, but Labor governments tend to do that, don't they?
Yes, and we've had some similar issues in Queensland. I think we'll probably see a change of government coming up in Queensland. As you say, politics is not really my bag normally, but yeah, those things. New South Wales had similar issues not so long ago, and there were some asset sales, and there's different ways that governments can go about it. I guess there was a whole range of factors through the lockdowns and so on that really have hammered state government debt in Victoria, but it will have to be tackled eventually.
Well, that reminds me very much of the early 90s when there used to be a joke, last person leaving Victoria turned the lights off. And when there was a change of government, when Jeff Kennett came in, he actually did sell off a lot of assets. There were some government utilities he sold off. There was schools and public land. I'm not sure how much of that's available at the moment to do, but you're right, a change of government often does change the feeling in the state, the confidence in the state, and the world moves on. We'll be back each month to talk about all these sort of things. And where will you be when I catch up with you in a month's time, Pete?
I'm not sure yet. Probably in Boston in the US. So just heading over for my brother's wedding. Got a bit of time in LA, and then I'll finally get back to Australia. I've been away for a little while. So looking forward to getting back to the sunshine probably around September.
Great. So I won't have to get up so early to do these podcast recordings with you, but I appreciate that you give up your time every month. I'm going to leave a link in the show note to your daily blog, which I enjoy reading, and also your great new book, The Buy Right Approach to Property Investing. Thanks for your time, Pete.
Always a pleasure. Thanks, Michael.
Well, lots of information from Pete Wargent, and I hope it's giving you confidence to know that despite all the challenges, there's lots of opportunities in our housing markets. Now, if you don't currently subscribe to this on either your podcast player or on YouTube where we play these audios as well, just stop for a second, subscribe so twice a week you get information from my guests and me. In a moment, I'm going to share my mindset message with you. But beforehand, I guess I'd like to just say, are you thinking about getting into the property market this year, either as an investor or a home buyer? If that's the case, you're probably like a lot of clients we see at Metropole, and you've got a number of questions you'd like answered. So why not go to metropole.com.au and organise an obligation-free chat with one of our wealth strategists and let them answer your questions. If you're stuck like many others are, or whether you're wondering should you buy, should you sell, or should you just wait in the current markets, go to metropole.com.au and organise a chat to discuss your questions with a wealth strategist. By the way, we have no properties for sale, and so therefore we can give you independent advice. By the way, we also much more than just a buyer's agent. We help our clients safely create intergenerational wealth through strategic property and wealth advice. And we're big enough to tip the scales in your favour, but still small enough to care. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you what I think is probably the biggest lesson I learned from Jim Rohn. And you know I quote my mentor very often. But he called it the great challenge in life. He said, here's the great challenge in life. You can have more than you have got now because you can become more than you are. I could stop there, and that's a great enough lesson, but let me repeat it. You can have more than you've got because you can become more than you are. And Jim Rohn said he found that your income seldom exceeded your own personal development. And I fully agree with that. You see, once in a while, you can take a lucky jump. You can buy the right property and the market suddenly picks up, or you can get into a business and it suddenly changes. You get an inheritance, you win the lottery, but I've seen it over and over again that unless you grow out to where it is, you end up going back to where you are. Somebody once said if you took all the money in the world and divided it equally amongst everyone, it would soon be back into the same pockets again. And I agree with that. However, you can have more because you can become more. You see, here's how the other side of the coin reads. Unless you change how you are, you'll always have what you've got. The major thing that makes a difference is what you do. It's the human effort that counts. So in order to have more, you need to become more. I remember Jim Rohn saying that some people said, if I had a job, I could really pour it on, but I've got this lousy job, so it's not going to work. I'm not going to work hard at it. If you've got that philosophy, Jim Rohn said, you're destined to stay in that bad job. Jim Rohn said, some people say, if I had lots of money, I'd be really generous, but I don't have much money, so I'm not generous. And he went on to say, see, you've got to change that philosophy or you'll never have lots of money. So my message to you is, unless you change, it won't change. Amazingly, however, when you throw out the blame list and start to become more of yourself, you learn more, you grow more, then all of a sudden, everything is going to change around you. Thank you for spending the last little while with me. I hope you got some benefit from this show. Hey, but before you move on to the next podcast you're hoping to listen to, please let me remind you that I have another show that I produce once a week with leading demographer Simon Kirstenmacher that we call Demographics Decoded, where we unveil the trends that are going to shape your future. This is a must-listen-to podcast for anyone interested in property investment, business or entrepreneurship. So if you don't currently subscribe to Demographics Decoded, please stop for a second and subscribe on your favourite podcast app or on YouTube. Now, if you did enjoy today's show and you know somebody else who'd benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just talk to them, tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour. You're definitely going to be doing me a favour in helping in my quest to make as many people as possible financially literate. Now, you can catch up with me in between these shows on social media, or you can join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group. And I've got a special bonus for you to say thank you for subscribing. Just go to podcastbonus.com.au. There's a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. That's my way of saying thank you to you for taking the time to listen. Oh, by the way, if you haven't listened to the many podcast episodes we've already got, we're well into our 600s of episodes now. You can always listen to the old episodes, which each have lessons about property investment, success and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?